A single reporting mistake could now cost you up to $10,000. And most people with foreign bank accounts have no idea they're even at risk. If you live in the United States and you or your family keep savings, investments, or any kind of financial account overseas, the rules have changed in a way that can affect you directly. This isn't just about wealthy people hiding money abroad. It also applies to ordinary immigrants, retirees, students, and families who kept accounts in their home country for convenience, security, or sentimental reasons. The IRS has tightened enforcement and clarified penalties in a way that makes even small or rarely used foreign accounts dangerous if they're not reported correctly. What's most troubling is that many people who are completely honest and pay all their taxes still end up in violation simply because they didn't know the reporting rules existed. Today, you're going to understand exactly what has changed, who is affected, and what practical steps you can take right now to avoid a penalty that can quietly build in the background and suddenly become very real. Hi, I'm Timothy, and I explain complex immigration and financial compliance rules so you can stay informed, protected, and compliant with U.S. law without feeling overwhelmed. If you've worked hard to build your life in the United States, followed the rules, paid your taxes, and tried to do everything the right way, the last thing you expect is to be hit with a penalty over an account you barely even think about. Maybe it's a small savings account your parents opened for you years ago. Maybe it's an inherited investment you don't actively manage. Or maybe it's a backup account in your home country that simply gives you peace of mind. What many people don't realize is that U.S. tax and reporting laws don't care how often you use an account or how important it feels to you personally. They care whether the account exists, whether you have control over it, and whether its balance passes certain thresholds at any point during the year. That's why understanding these updated expectations and enforcement priorities isn't just useful. It's essential if you want to avoid unnecessary stress, surprise penalties, and complicated compliance problems later. What makes this moment different is that the IRS no longer treats foreign account reporting as a narrow issue affecting only a few high net worth individuals. Enforcement is being applied more broadly with clearer rules and stricter consequences for anyone who falls under the reporting requirements, even by accident. This matters because many people in the U.S. still have normal, legitimate financial ties to their home countries. They might have a retirement account funded before they immigrated, an account their family used while they were students, or a joint account used to support relatives abroad. In their minds, these accounts feel distant and unrelated to their current U.S. tax life, so they never imagine that simply not reporting them might be treated as non-compliance. In reality, U.S. tax law is built around global visibility. If you're a U.S. taxpayer, whether as a citizen, green card holder, or certain long-term residents, the government expects transparency about financial accounts you control outside the country, even if those accounts don't generate income and are rarely touched. This broader enforcement climate is exactly why so many otherwise careful taxpayers are suddenly learning that something they ignored for years has turned into a genuine financial risk. To see how this works, you first need to clearly understand the central reporting rule behind all of this. The requirement to file what's commonly known as an FBAR, report of foreign bank and financial accounts. This is not a regular tax form that you mail with your income tax return. It's a separate electronic report filed with the Financial Crimes Enforcement Network, FinCEN. It applies if the total value of all your foreign financial accounts combined exceeds $10,000 at any point during the calendar year. The critical phrase is "at any point." Even if the balance only goes above $10,000 for a single day, the reporting requirement can be triggered. Another common misunderstanding is thinking each account is evaluated separately. In reality, the rule looks at the combined maximum balance of all qualifying foreign accounts. So if you have two overseas accounts with $5,000 each, together they cross the threshold. Even though each one individually seems small, it also doesn't matter much what type of account it is: checking, savings, brokerage, mutual fund, or other kinds of financial accounts held abroad. If you have a financial interest in the account or signature authority over it, and the combined value crosses the threshold, the law generally expects you to report it. On top of the FBR requirement, there's another layer of reporting that often causes even more confusion: Form 8938, which is filed with your annual federal income tax return. While the FBAR focuses on foreign financial accounts and is filed separately through FinCEN, Form 8938 is an IRS form designed to disclose specified foreign financial assets when they exceed certain thresholds. These thresholds vary based on your filing status and whether you live in or outside the U.S., which is one reason many taxpayers assume it doesn't apply to them. For example, a single filer living in the U.S. may need to file Form 8938 if their foreign financial assets exceed $50,000 at the end of the year, or $75,000 at any time during the year. Thresholds are higher for married couples filing jointly, but the important point is this. FBAR and Form 8938 are not interchangeable. Filing one does not automatically satisfy the requirement for the other. Many people submit their tax return without Form 8938, believing they're fully compliant while also not filing an FBAR at all. This layered structure is exactly what creates compliance gaps. Not because people are trying to hide anything, but because the system is technical and fragmented if you've never had it clearly explained. What has increased concern recently is not just the existence of these forms, but the way the IRS has clarified and reinforced the penalties for getting them wrong or ignoring them. For non-willful violations, cases where someone simply didn't know they were supposed to file, the penalties can still be up to $10,000 per violation. Those violations can stack across multiple accounts and multiple years. For willful violations, where the IRS believes someone deliberately avoided reporting, the penalties become much more severe, potentially the greater of $100,000 or 50% of the account balance per violation. What worries many taxpayers even more is that these rules don't only apply going forward. Past years where required forms weren't filed can still be looked at, especially now that international financial data sharing has expanded. That means a reporting oversight from several years ago, something you barely remember, can suddenly reappear as a current compliance issue. This realization is exactly what creates so much anxiety. People who've always tried to follow the law suddenly see that simply not knowing about a requirement could bring consequences they never expected. At this point, a natural question comes up. How would the IRS even know about an account in another country, especially if you haven't moved money recently? The answer is in the global financial transparency systems built over the last decade. Many foreign financial institutions now share account information with U.S. authorities under international agreements aimed at reducing tax evasion and improving reporting accuracy. This means that even if you never mention an overseas account on your tax return, its existence may still be visible through data exchanges. You don't have to move large amounts of money or trade actively. In many cases, simply having an account in your name or having signature authority can be enough for it to appear in cross-border reporting. This doesn't mean the IRS is automatically targeting honest taxpayers, but it does mean the old belief that no one will ever know because I barely use that account is no longer a safe assumption. The system has quietly evolved to increase visibility, which is why awareness and proactive compliance are far more important now than they were in the past. If this is already making you rethink accounts you may have forgotten about or never considered relevant, that's actually a good sign. The biggest risk usually comes from not knowing the rules exist in the first place. Staying informed about changes like these can save you from stress and surprise penalties later on. That's exactly why clear updates on financial compliance and immigration-related obligations matter so much for anyone with international ties. If you find this kind of direct, practical explanation useful, make sure you stay connected so you don't miss future updates that could directly affect your legal and financial standing in the United States. Now that you understand the framework, the next crucial step is knowing who is most affected by these enforcement priorities, because the group at risk is much broader than most people assume. Seeing where you fit in that picture will help you decide what actions, if any, you should take next. The people affected by these reporting rules are not a small, specialized category. In reality, they include a wide range of everyday individuals whose financial lives naturally cross borders. Green card holders who kept bank accounts in their original country, naturalized citizens who inherited investments from relatives abroad, retirees receiving foreign pension payments, international students whose parents support them through overseas accounts, small business owners who occasionally use foreign financial institutions, Even having signature authority over a joint family account can create a reporting obligation, no matter whose money it actually is. This is where many misunderstandings start. People tend to associate these risks with huge balances or complex offshore structures, but the law focuses on access and control, not just formal ownership. If your name is on the account or you can direct how funds are used, that alone can be enough to trigger reporting once the thresholds are reached. Realizing that the rules apply to such ordinary situations can feel uncomfortable at first, but it also makes the goal clearer. Transparency, not automatic punishment. Understanding your specific role in any foreign account is the first critical step toward staying compliant. To make this more concrete, imagine someone who moved to the US many years ago and left behind a modest savings account in their home country, opened long before they ever thought about immigrating. Over time, their life in the US became their focus. They filed taxes correctly each year, and that small account faded into the background. From their point of view, it's irrelevant, more of a forgotten detail than a real asset. But from a reporting perspective, if that account's balance ever went over $10,000 during the year, the requirement to disclose it could still apply. The purpose of the rule isn't to punish people for maintaining ties to their home country. It's to make sure foreign financial relationships are visible within the tax system as a whole. This example shows how easily an honest taxpayer can miss a filing requirement, simply because the account feels unimportant emotionally, even though legally it still counts. Consider another common case, an inherited investment account overseas. A person becomes a U.S. citizen and later inherits a brokerage account from a parent in another country. The account is professionally managed. Statements come in frequently. The beneficiary rarely touches it. Because they're not actively trading or moving money, they assume it has nothing to do with their U.S. tax situation. But if that account's value crosses the reporting thresholds, it can trigger both FBAR and possibly Form 8938, even if they never withdraw a single dollar. Again, the issue is not activity, but existence and value. That's why passive accounts, inherited accounts, and accounts run by foreign advisors can still create reporting duties. Many people only discover this after talking to a tax professional, attending a seminar, or watching content like this. They're often shocked to learn that simply overlooking a disclosure requirement, even with no intent to hide anything, can still be treated as non-compliance. What makes these situations complicated is that most violations are not driven by deliberate concealment, but by assumptions that feel logical and turn out to be wrong. People often believe if the account is small, inactive, or mostly used by relatives overseas, it doesn't need to be reported. If there's no income, there's nothing relevant for U.S. tax. If the account was opened before they became a U.S. taxpayer, it somehow doesn't count now. These ideas make sense from a personal perspective, but they don't match how the reporting rules are actually written. The law looks at financial interest, signature authority, and thresholds, not at how often you use the account or how emotionally important it is. Recognizing this difference shifts your mindset from "I didn't do anything wrong" to "I need to confirm whether any reporting is required," which is much more protective. By understanding that many problems come from simple lack of awareness, you can move from anxiety to clarity and start taking practical steps to stay aligned with the rules. With that clarity, the next step is moving from knowledge to action. Knowing the rules only helps if you use that knowledge to review your own situation in an organized way. The first practical step is to determine whether any foreign financial accounts you're connected to ever pass the relevant thresholds during the year, even briefly. That means looking not only at accounts you actively use, but also older accounts, joint family accounts, inherited investments, retirement funds abroad, and any account where you have signature authority. The key is to think broadly and honestly about your global financial footprint, rather than focusing only on accounts you personally consider important. Once you've identified those accounts, the next step is to collect accurate information: the bank or institution name, account numbers, and the highest balance during the year. This sounds technical, but often it starts with simply gathering statements or asking the bank for a summary of yearly maximum balances. Doing this gives you a clear picture of whether reporting rules apply and replaces uncertainty with facts, which is always your best defense against unexpected issues. After you gather that information, you may realize that reporting should have been done in past years but wasn't. This is the point where many people feel a rush of fear, imagining immediate penalties. But it's important to know that there are established ways to correct past non-willful mistakes when you act voluntarily. Addressing the problem before any official notice arrives usually lets you resolve things under far more manageable conditions than if the IRS first learns about the issue through foreign bank reporting. Timing and intent matter. Acting early shows you're trying to comply and reduces the chance that the situation will grow into something more serious. Instead of seeing missed filings as a permanent disaster, it's more useful to see them as a gap that can be fixed. With correct information, the right forms, and when needed, professional help. If you discover that you missed required forms in earlier years, the most important thing is not to panic, but to respond calmly and quickly. The IRS has procedures for taxpayers who come forward and correct past reporting gaps when those gaps were non-willful, caused by misunderstanding or lack of awareness, not by deliberate hiding. Using these procedures normally means filing the missing reports for prior years, accurately listing the accounts, and certifying that the failures were unintentional. Taking this initiative often puts you in a much stronger position than waiting and hoping nothing surfaces. Once the IRS or another agency sends a notice based on outside data, your options can narrow, and the process can become more stressful and complicated. In contrast, voluntary correction shows cooperation and responsibility, two factors that strongly affect how your case is viewed. The bigger lesson is that discovering a past oversight does not automatically mean facing the harshest penalties. In many cases, it simply means taking organized steps to bring your records into line with current requirements. As you move forward, it's also smart to build habits that make future compliance easier. Keeping organized records of all foreign accounts, including yearly maximum balances, statements, and any letters from the bank, can make each year's reporting much simpler. Saving copies of submitted forms and related documents means that if questions ever come up, you have proof of what you reported and when. This kind of record keeping isn't about expecting an audit. It's about creating a clear paper trail that gives you confidence and control. When documents are organized and easy to reach, even complex international reporting starts to feel manageable. Over time, this turns compliance from something scary into a routine task, reducing the risk of last-minute confusion or forgetting obligations that could lead to avoidable problems. There are also situations where professional guidance is especially valuable, not because you've done something wrong, but because international reporting can have tricky details that aren't always obvious. For example, people who have multiple foreign accounts in different countries, interest in foreign retirement plans, involvement in family businesses abroad, or access to joint accounts they don't personally fund, may face reporting questions that need careful interpretation. A tax professional experienced in international compliance can help confirm which forms apply, check that balances and thresholds are calculated correctly, and point out any extra disclosures that might be needed. This kind of review can bring real peace of mind when your financial life spans more than one country and each place has its own rules. Instead of seeing professional advice as something only needed in an emergency, it can help to view it as a preventive measure that strengthens your overall compliance and lowers the chance of future surprises. To see how easily these obligations can arise, think about someone who immigrated to the US and left a fixed deposit account in their home country, opened years earlier with help from their parents. The account sits quietly, earns modest interest, and is rarely discussed or touched. Yet its balance might still exceed the reporting threshold in some years. Personally, the account feels like a distant leftover, not part of their current life. So it never comes to mind at tax time. Only later, through a community event or an informational video, do they realize that the account's mere existence created a reporting obligation? The shock is real, but it's also an opportunity to collect the needed information, file the appropriate disclosures, and stay compliant going forward. Stories like this show how common and understandable these oversights are, and why staying informed is one of the best ways to protect yourself from penalties while keeping up with evolving rules. Stepping back, it's useful to understand why these rules have tightened in recent years. Governments around the world are working together more closely to reduce tax evasion and increase financial transparency across borders. That has led to expanded data sharing between countries and tougher reporting expectations for taxpayers with international ties. From a policy viewpoint, the goal is not to punish ordinary people with legitimate foreign accounts, but to ensure that all global income and assets linked to U.S. taxpayers are visible. However, as enforcement becomes more automated and robust, the practical effect is that even small, unintentional gaps are more likely to be noticed than before. This means relying on old assumptions about privacy or invisibility of foreign accounts is no longer safe. The modern approach to compliance is built on proactive disclosure and clear documentation, recognizing that transparency is now part of the global financial system, not just an optional extra step. If you boil everything down, three core ideas stand out as especially important for protecting yourself. First, foreign account reporting is triggered by thresholds and control, not by how often you use the account or how important it feels in your daily life. Second, missing a filing requirement is often a fixable problem, especially when you address it voluntarily and in good faith before any official inquiry starts. Third, make it a habit to review your global financial connections each year, even briefly, so nothing gets forgotten or overlooked as your life changes. These principles shift your focus from fear of penalties to confident, informed compliance. They allow you to follow the rules without constantly worrying about hidden risks. In the end, the purpose of understanding these rules isn't to scare you. It's to give you clarity and control over a part of your financial life that usually gets ignored until it suddenly matters. Most people who find themselves at risk of penalties are not trying to hide anything. They're living across borders, maintaining ties to their home countries, and doing their best in a system that was never clearly explained to them. By staying informed, reviewing your accounts honestly, and acting in a timely way when needed, you put yourself in a strong position to remain compliant without unnecessary stress. Instead of worrying about what might go wrong later, you can move forward with the confidence that you've taken the right steps to protect your finances and legal status in the U.S. Awareness, organization, and proactive action together form the most reliable safeguard against unpleasant surprises, and they allow you to focus on building your life and future instead of looking back at missed obligations. Before we finish, remember that everything discussed here is for general information, to help you understand how foreign account reporting rules and penalties might apply in common situations. Individual financial and immigration situations can differ a lot, and small details about account structure, ownership, or residency can change your exact obligations. That's why it's always wise to double-check details with official government resources and, when needed, consult a qualified tax professional who can look at your specific case and give tailored advice. Staying informed, asking the right questions, and seeking accurate guidance when necessary are the best ways to ensure long-term compliance and peace of mind. Thank you for spending this time with me and taking a proactive step toward protecting your financial future.